Hey guys, Dan here. In this video, I'm going to analyze the stock of the 3M company and try and figure out whether it's a good deal right now. If you're new to the channel, my name is Dan. We do a lot of stock analysis and investing videos on this channel. So if you're into that kind of thing, hit that subscribe button to check out more of my videos. Alright, let's jump into it. Okay, so the 3M company makes all kinds of products that we all use every day, and we probably don't even know we're buying 3M products. Here's just a summary of all the categories that they're into. So in general, 3M's product can be classified into three categories. You've got safety and industrial products, transportation and electronics, and even healthcare. And here's just a breakdown of the percentage of revenue of each category. I'd like to look at the revenue by region just to get a sense of how diversified the company is, whether they're multinational or not, and also just see if we have some currency hedging. So 41% of their sales are in the US, 31% in the Asia Pacific region, Europe, Middle East, and Africa account for 20%, and just 8% from Latin America and Canada. One of the main reasons investors are interested in this stock is their steady increasing stream of dividends. The company has managed to increase their dividend every year for the past 62 years. Currently, if you buy the stock right now, the dividend yield is 3.39%, but just consider they have a 5-year average growth rate in their dividend of 10.99%, or just about 11%. So here we have the past 5 years. You got 2016 to 2019, and I got a trailing 12 months or TTM measure, meaning the first 3 quarters of 2020 plus the last quarter of 2019, since that is the most recent data we have. What we can see here is that steady increasing stream of dividends in blue. Quite impressive, but equally as impressive is the money they've given back to shareholders in the form of share buybacks, which has also gone up over time. When we look at these dividends and these share buybacks, it's also important to look at the payout ratios. So in blue here I have the payout ratio, which is essentially the total dividend they pay divided by the total profit they earned that year. One thing I don't love to see is that it's gone up from about 30% to 50% in the past 5 years. What I do like to see is that it's still only 50%, which means they have an extra half of their profits they can reinvest back into the business. Now, this company is not a R&D intensive company, I would not think. So they are not reinvesting it all back into that sort of thing. What you can see from this chart here is rather than reinvesting it, they're actually just using the extra money to buy back their own shares. So you see in the green here, this modified payout ratio, that's the dividends plus the money spent on share buybacks, all divided by the profits. Now, unfortunately, this ratio exceeds 100% in the past 2 years. So that's not something that's going to be able to continue, obviously. You can't pay out more than you make. But it is a very good sign going forward. When a company buys that much of its own shares back, usually a positive signal about their future prospects. And as well, by buying so many shares back, they're making it easier for themselves to increase the dividends going forward because there's fewer shares they have to pay on. Turning to their balance sheet, possibly because of all these share buybacks being greater than their earnings, they have had to borrow money. And you can see their liabilities-to-assets ratio is about 73% right now, which is, moderately high. Their working capital is positive. They get a current ratio of 1.9. Current ratio just means current assets divided by current liabilities. So what this means here is that they can easily cover the money that they owe within the next year with their current assets. They can cover it 1.9 times. So they're very safe. They're very safely above 1. The quick ratio is 1.37. If you don't know about all these ratios, I put them in the description below. But essentially the quick ratio is a lot like the current ratio, but you take out the inventory. So no liquidity problems here at 3M. And no solvency problems anytime soon. You see their interest coverage ratio is 13.3. So their profits before interest can cover their interest expense over 13 times. Okay, so here's a DuPont analysis. If you don't know about DuPont analysis, check out my video on that in the description below. But essentially, we're taking return on equity. and just decomposing it into its three components. One of those components, net income margin, just tells us that for every dollar of sales the company generates, how much money do they keep in profits? And for 3M company, it seems to be around 15 or 16 cents. Not bad at all. Asset turnover, for every dollar of assets, how much sales can you generate? It has fluctuated. For this company, it looks to be around 0.9. In the most recent year, they did not generate as much sales per dollar of assets they had. The equity multiplier here is showing you the effects of leverage. And yes, the company has become more highly levered, just as I had suspected with those share buybacks. You can see their equity multiplier going up. So in the end, they achieve an ROE of 49% in the most recent year. I love to see that. That's very high. Okay, so their ROE is partially driven by leverage, but it's also partially driven by an excellent business. So overall, I like their profitability. Okay, at this point in the video, I want to use an intrinsic valuation model to try and figure out what is a fair price for a share of 3M company stock. So I'm going to use the dividend discount model. I think it's a perfect model to use for this company because they pay out a very large portion of what they earn as dividends every year. They're not a growth company. They're definitely in the maturity phase. And so this model is going to fit the company pretty well. One caveat about the model, okay. The model gives you the fair value of the company given this stream of dividends. It does not account for any potential share buybacks that may happen in the future. So that's kind of gravy, in other words. This will give you the minimum value for the stock. Otherwise, it's very similar to the free cash flow from equity model that I would normally use. So what we do, we're going to estimate next year's dividend, which they already forecasted is $5.88. And then we are going to adjust that for some kind of growth we expect to see within the next 5 years. After that time period, we'll assume the dividends can grow in perpetuity at some kind of small rate, just keeping up with inflation. Now, dividends have grown every year at an average of about 11% a year for the past 10 years. Will that continue? I don't know. I'm going to show you guys how the value is with that estimate and then how that's going to change if we fall short of that a little bit. The discount rate chosen, I'm going to go with the lower discount rate. Not super low, not 4 or 5%, probably about 6% would be fair for this company. They have a very stable business. They generate incredible margins. Their balance sheet, I give it a B or a B minus. It's not the healthiest, but it's certainly not in danger anytime soon. So I think a little bit lower than average discount rate would be appropriate. But again, I'll show you the value of the company if I change that discount rate a little bit. Okay, so rather than just presenting a one number and saying this is the fair value of the stock, I like to make a matrix of values here. Each cell in this matrix represents the value of a share of 3M company stock given a certain discount rate and given a certain growth rate in their dividends. So if we assume that 6% discount rate and we assume they're going to grow dividends at 10% per year over the next 5 years, and then the dividend will slow down to a 2.5% growth rate after that. If we assume those are true, the stock would be worth about $220 today. Given its current share price, it'd be an excellent deal. But I definitely wanted to show you how this can vary with different growth rates and different discount rates, so you can get a fair picture of it. Another way of interpreting the whole matrix is to say the following, is to say, okay, if I want a 7% return on my investment, and I think the company can grow their dividends at just 8%, then I should only be willing to pay $155.93 for a share of this company's stock. So check out the matrix below. It gives you kind of a visual, and we can see that if you assume a higher discount rates, lower growth rates, those are color-coded red. That would mean the stock would be overvalued at its current price. If you are a little more optimistic, you can see in green here, the stock could potentially be very undervalued. If you assume a 6% discount rate and that 10% growth rate in dividends, you're looking at close to 27% undervaluation. So taken together, it's a mixed picture. It depends on your forecast of things. Again, this understates the value of the company, though. This is the minimum value. So when you consider that, it does seem like a good deal. One thing I always like to look at is insider trading activity. The board of directors and the executives have a lot of information we don't have. So when you see big sell-offs, that's a danger sign. And conversely, when you see them loading up on their own stock, that should be a hint for you to do so as well. Here we kind of have a mixed picture in terms of the number of insider buys and insider sales. If I look at the number of shares involved, it's really not that many shares in the past 12 months or even the past 3 months. There are a lot more insider sales than insider buys, but the total number of sales is really not that great here. I would say it's close to no activity in the past 3 months. Okay, so here are my final thoughts, guys. I think the 3M company has a fair balance sheet. They have pretty impressive profitability and certainly an impressive track record of growing their dividend. When we run the numbers and we look at a valuation of the company, they do seem to be a bit underpriced, especially when you consider that the dividend discount model I used tends to understate the value of the company. If anything, it's kind of like a floor for the value. So yeah, I think it's a good deal right now. It's definitely not the kind of stock that's going to give you 100% return in 2 years. That's just never going to happen with a company like 3M. But it is a very predictable source of income. And so yeah, I think I'm going to add it to my portfolio. That's just my opinion. If you enjoyed that video, click that like button. I appreciate it. Thank you for watching.